Ever feel like your fixed deposits just aren't keeping up with inflation, but the stock market makes your heart race faster than Kopi Kosong Gao? What if there's a middle ground, something that pays you monthly income, but doesn't swing like a roller coaster? Today, we're diving into bond funds, specifically the PIMCO Income Fund, and why more Singaporeans, especially retirees, are paying attention. If you want more everyday Singaporeans to understand this too, please give this video a thumbs up. It helps push it out to more people like you. If you're retired or planning for retirement, subscribe to Wealth for You and watch till the end. This could change how you plan your next 10 years. Disclaimer: this video is meant for educational and informational purposes only. It does not constitute financial advice. Please remember to do your own research and consider speaking with a licensed financial advisor before making any investment decisions. Chapter 1. U.S. Interest Rates. What's going on? Let's zoom out a bit. The global investing climate right now? One word: messy. We're talking about tariff wars, sticky inflation, recession fears, and yes, even Trump's crackdown and deportation headlines are making markets sweat a bit. He really knows how to shake things up. But here's the plot twist. Despite all that noise, the U.S. economy is still chugging along. Inflation has been cooling, and unemployment remains stable. Now here's where it gets interesting for investors. The U.S. Federal Reserve has kept interest rates unchanged since end of 2024. But experts, and some very seasoned fund managers, believe we might see rate cuts in the second half of 2025. Why? Because the Federal Reserve, or Fed, wants to see how new trade tariffs and economic policies play out. And here's a juicy tidbit. A new Fed chair is expected to take over after May 2026. Historically, new leadership at the Fed often comes with a shift in tone. And this new chair could be more dovish, meaning more open to cutting rates to support the economy. But let's be real, nothing is confirmed yet. Even current Fed Chair Jerome Powell said recently, "We must be humble. This is an unprecedented environment." Still, if you believe interest rates are heading down eventually, then bond funds might just be your secret weapon. Because here's the golden rule of bonds. When interest rates fall, bond prices rise. So, if you lock in a high-yield bond fund before rates fall, you could enjoy not just steady monthly payouts, but capital gains too. And that's why more investors are quietly eyeing bond funds right now, even before the headlines catch on. Chapter 2. What is a bond? What is a bond fund? Okay, let's not assume everyone here last worked at GIC or Temasek. Let's break this down real simple. A bond is like a loan, but instead of you borrowing money from the bank, you become the lender. You lend money to a company or government, and in return, they pay you interest regularly, which is called a coupon. At the end of the bond's term, say 3, 5, or 10 years, they return your money to you. Pretty neat, right? It's like lending your friend $100 with the promise he gives you $5 every year for 5 years, and then returns your $100 at the end. Except in this case, your friend is a big corporation or government. But here's the catch. Buying individual bonds can be very ma-fan. You need to choose the right ones, check credit ratings, maturity dates, interest rates. And some of them require big minimum investments, like $250,000 or more. That's where a bond fund comes in. Think of it like your local economic rice stall. Instead of committing to one big slab of chicken chop, you can choose a little bit of everything: fish, egg, tofu, vegetables, all on one plate. A bond fund pools money from many investors and spreads it across many bonds: corporate bonds, government bonds, even global ones, so you don't need to pick and choose one by one. The fund manager is like the hawker auntie who decides the mix for you based on what's fresh and what works together. The result? You get instant diversification, meaning your risk is spread out, and the whole thing is managed professionally, so you don't have to stress about tracking bond prices daily. In short, want passive income with less drama? Bond. Want convenience and global exposure? Bond fund. And later on, we'll show how the PIMCO Income Fund does this very well, especially for investors who want monthly payouts. Chapter 3. How bonds work with interest rates. Okay, this part is super important, like knowing when the CBD taxi peak hour surcharge kicks in. There's a simple rule every bond investor must understand. Think of it like this. When interest rates fall, bond prices go up. When interest rates rise, bond prices go down. It's like a seesaw. Interest rates on one side, bond prices on the other. When one goes up, the other goes down. Let's say you bought a bond that pays you 4%. But next year, the market rate drops and new bonds only pay 3%. Suddenly, your bond, which pays you 4%, becomes more attractive, right? So other investors are willing to pay more for it, just to get your higher 4% yield. That's how your bond increases in value, even before maturity. Now, if you're investing in a bond fund, the same thing happens inside the fund. As interest rates drop, the bonds inside the fund become more valuable, and the price, which is the NAV of the fund, goes up. So not only do you get steady monthly payouts from the coupon income, you could also enjoy capital gains if bond prices go up over time. That's why some savvy investors are quietly starting to move money into bond funds before interest rates start falling again. They're positioning themselves to benefit from both sides, income plus upside. Chapter 4. Why some Singaporeans love bond funds. Now, so here's the good stuff. Imagine this. You're a retiree in Singapore. You've worked hard, raised your family, and now you want your money to work for you, without giving you a heart attack every time the market sneezes. You're not looking to become the next Warren Buffett. You just want something steady, reliable, and maybe, just maybe, something that pays you every month like clockwork. That's why many are turning to bond funds, and especially to options like the PIMCO Income Fund. Let me paint you the picture. Every single month, this fund has been paying out about $0.04547 per unit. Doesn't sound like much? But add it up. It works out to around 6.6% yield per year. That's way better than fixed deposits, and yes, it's been pretty consistent. And you're not just lending money to one company. These funds are like a global buffet, spreading your risk across dozens or even hundreds of bonds, including strong investment-grade names. If one bond sneezes, the whole portfolio doesn't catch the flu. And while the stock market loves to be dramatic, up 3%, down 2%, up again at lunchtime, bond funds tend to be more stable. Sure, there's still some movement, but it's usually less roller coaster, more travelator. Best part? Even if the market throws a tantrum, your bond fund doesn't care. It just keeps doing its job, paying you income quietly in the background. For Singaporeans who want peace of mind and regular payouts without the drama, bond funds are really starting to shine in this environment. Chapter 5. But wait. Got downsides also. Okay, before you rush to dump all your Kopi money into bond funds, let's talk about the not-so-sexy side. Because just like durian, some people love it, some people keen a surprise. 1. NAV can go down. Even though you're receiving monthly payouts, the fund's net asset value, which is the price of your fund units, can slowly drop. Why? If interest rates stay high, the bonds inside the fund lose value. And while the fund manager keeps paying you your monthly income, sometimes that payout doesn't come just from the interest earned. In some cases, they dip into your capital, like eating your cake now instead of saving it for later. So yes, you're still getting that juicy 6% income, but your fund value might be quietly shrinking in the background. It's like receiving ong bao money every month, but later realizing it came from your own savings account. 2. High management fees. Another thing, retail bond funds, like the standard PIMCO Income Fund, charge annual fees up to 1.54%. That's quite a bit, especially if you're only earning 5 to 6% yield. But if you use platforms like Endowus, they give you access to institutional share classes with lower fees, as low as about 0.55%, and no trailer commissions. So always double-check before you invest. Don't let hidden fees catch you off guard. 3. Not for fast capital gains. Let's be honest. If you're hoping for capital gains of 20% returns like Nvidia or Tesla, this is not the place. Bond funds are more like slow, steady tortoises. They won't win sprints, but they may help you sleep better at night. Perfect for retirees who want predictable cash flow, but maybe not for young adrenaline junkies looking for fast profits. So bottom line, bond funds can be a great tool, but you must know what you're buying. It's not free lunch. Got income, yes, but also got trade-offs. Chapter 6. How to choose the right bond fund. So you've decided to explore bond funds. Good move. But wait, before you click Buy, here's a simple checklist to help you choose the one that actually suits your needs. 1. Need regular income? Look for distribution share classes. These are the versions that pay out income to you monthly or quarterly. For example, the PIMCO Income SGD-hedged Inc. class pays about $0.04547 per unit monthly. Great for retirees who want steady, predictable payouts to cover expenses like groceries or copy sessions. 2. Don't need the income yet? Then go for accumulation share classes. These reinvest the income back into the fund, helping you grow your capital over time. Perfect for younger investors who are still working and can afford to delay income for future gains. 3. Prefer stability. Choose SGD-hedged bond funds. This helps you avoid currency swings that could eat into your returns. After all, if you're spending in Singapore dollars, why take on forex risk? 4. Don't just look at the yield. Yes, 6% sounds chic, but always check duration. Longer duration means more sensitive to interest rate cuts, so more upside potential if rates fall. Credit quality, higher quality bonds are safer but offer lower returns. Junk bonds pay more but are riskier. Down market performance, see how the fund held up in past rough patches. You want something resilient, not fragile. Think of it like shopping for shoes. You don't just buy the flashiest one. You check the size, grip, cushioning, and whether they give you blisters. Same for bond funds. Match it to your lifestyle and what you actually need. The PIMCO GIS Income Fund is a globally diversified, SGD-hedged bond fund that's become a favorite among income-seeking Singaporean investors, especially retirees, thanks to its steady monthly payouts of around $0.04547 per unit, equivalent to a 6.6% annual yield. It's easy to access via platforms like POEMS and Endowus, and offers stability without the forex risk. However, investors should be aware that the fund's net asset value, NAV, has dipped slightly in recent years due to high interest rates, and part of the payouts may come from capital. Still, for those with a long-term horizon who believe rates will eventually fall, the fund offers a balanced mix of income and potential capital recovery, a steady, no-drama option for your golden years. Final thoughts. If you're a Singapore retiree or planning to retire soon, and you're looking for something a bit more exciting than a fixed deposit, but also less heart attack-inducing than the stock market, then bond funds like the PIMCO Income Fund might just be your sweet spot. They give you monthly payouts, help you stay invested without all the drama, and may even offer some capital upside if interest rates drop. But remember, don't go in blindly. Know your financial goals, understand the risks, and always choose the right share class. whether you want regular income or prefer to grow your capital quietly in the background. If this video helped you see bonds in a new light, give it a thumbs up. It tells YouTube to show it to more Singaporeans who need this info. Subscribe to Wealth for You for more real talk about investing, retirement, and income planning, without all the technical fluff. And if you know someone, maybe your friend, colleague, or even your parents, who's thinking about retirement, share this video with them. You might just help them make a smarter decision. Got questions about bond funds or want me to compare a few for you? Drop them in the comments. I read and reply to everyone. Thanks for watching. Happy investing. And as always, stay chill lah.